say we were in the status quo and hadn't passed this bill, and the tools that existed 2 years ago, we'd be a lot more vulnerable today than we are without this. So I thank you. Senator Bayh.
Mr. Chairman, this may be my last opportunity to interact with you in this capacity, and I just want to take this moment to thank you for your service to our country once again, and to say it's been a pleasure working with you on some of these issues.
Thank you.
My first question has to deal, there have been a lot of comments here about our budget deficits and debt, which is accurately described, as you pointed out, as unsustainable. I'd like to ask about another unsustainable disequilibrium, and that is our current account deficit and the corresponding current account surpluses in China and other parts of the developing world. Mm-hmm. Many observers believe that it was this disequilibrium that gave rise to a glut of global capital that undergirded the asset bubble that led to some of the problems that we've seen. There were some signs that it was beginning to be self-correcting. Savings rates in our country were going up. Consumption in China is rising. But the most recent data suggests that perhaps the current account imbalance is once again on the rise. So my question to you is, how concerned about this should we be? And given the apparent return to the status quo ante in terms of the gap, is this going to be self-correcting, or do other measures need to be taken?
Well, first on the forecast, the current account deficit did drop from about 6% of GDP to about 3% of GDP, and it has increased slightly, but our view is that in the medium term it's not going to go back to where it was. That we have made some progress in that respect. But to continue with the progress, we need to continue to have global adjustment, and that essentially means that surplus countries like China and others need to increase their reliance on domestic demand, and where appropriate have flexible exchange rates. And the United States has to do its part, and this ties back to your first comment about sustainability, which is that in order to reduce our current account deficit, we have to increase our national saving. Better fiscal position is part of that. Higher household and business saving is part of that. So that is an important imperative, one that the IMF and other international agencies continue to focus on. And I absolutely agree with you that if the current account deficit were to return to 5 or 6% of GDP, that would be a very worrisome situation.
Well, let's hope we can get some bipartisan cooperation on here and getting our fiscal house in order, which will help with the savings issue. Let's hope the Chinese will continue to move in the area of currency flexibility. Mm-hmm. So you're, as you look out to the future, you think that 3%, is that going to be about where it'll be, you think? And if so, that's clearly not 5 or 6. Is that sustainable at a 3% rate?
For the next few years, that's our estimate, but it's just a forecast.
Okay, I just saw the monthly figures last month, so hopefully that's doesn't augur a return to something more aggressive.
So we don't focus on bilateral trade deficits, U.S.-China.
Yeah,
we look at the overall,
right.
And that's somewhat different.
My second question has to do with the Greek debt crisis once again. And as you pointed out, the Europeans moved very aggressively, and things seem to have calmed down a fair amount there. But I look with some alarm, even if they implement all these austerity measures that they're thinking about. And as you can see, there's a fair amount of political turmoil around all that. It looks as if they're still going to be at about 130% or so of debt to GDP ratio, even after they've implemented all these steps. And just speaking, putting my political hat on, it could be pretty hard for them to go substantially beyond that. So that still looks like it's going to be pretty hard to sustain a situation like that. So I don't expect you to comment upon the likelihood of restructuring or anything like that. But you had mentioned that whole episode, while it caused some disturbance, we've now kind of gone beyond that. So my question would be, in the event of an orderly restructuring of Greek debt at some point, I assume that would also have only a marginal impact upon our own markets.
Well, what I think is important is that at least for the next few years, the Europeans have provided enough funding to assure no restructuring, no default. And that's important because we remain vulnerable in our recovery, in our financial markets, to kind of stress that would cause. So I am encouraged by the commitment of the Europeans to the large amount of funding. The other side of their program, though, is also to create what the IMF would call conditionality, which is that they are strengthening their within European mechanisms for achieving fiscal sustainability within their members. So the countries that receive assistance will also be under a lot of pressure from their peers within the Eurozone or within the EU to make appropriate adjustments.
That actually leads me to my final question. I'll make one comment I don't expect you to respond to, but a skeptic might look at all this and say that what was really at work here was a choice between an eventual orderly restructuring or a disorderly restructuring that could have been very destabilizing. And so what the Europeans are attempting to do is to recapitalize their banks and get them in better shape for the eventual haircut that may lie down the road at some point. So that's just an observation some have made about what's transpiring there, and hopefully the world economy will be in a stronger position and be willing to absorb all of that if in fact something like that happens. But we had a great hearing yesterday, and I want to thank you for making Mr. Turullo available. His testimony was very candid, very insightful, very helpful, and that was about the importance, since we passed our financial regulatory response to the crisis, the importance of global harmonization and convergence about standards and enforcement mechanisms and all that. And you mentioned I'm sure many of the Europeans, particularly the Germans, wish that they'd focused a little bit more on some of the enforcement mechanisms with regard to government fiscal policy at the time they had formed the common currency. And so my question to you, Chairman, my final question would be, how important is it to our country that we continue to have harmonization of standards, and particularly that there are enforcement mechanisms in place to ensure that those standards are abided by most of the time, because that's going to be important to, I think, avoiding a reoccurrence of the crisis at some point. And secondly, there are some competitiveness aspects with regard to this that could affect American institutions.
Well, it's very important. We're not going to have perfect harmonization because countries are in different situations. They have different banking systems, different financial systems. But we are making good progress in negotiating with our colleagues a strengthening of capital and liquidity standards that will help make our banking system more stable in the event of another stress event, as we recently saw. We don't really have binding mechanisms to enforce the agreements across borders. Every country applies the Basel standards within its own borders according to its own decisions. But we do work closely together and apply peer pressure and other mechanisms to try to keep the standards very similar, and indeed our very key objective over the next few months is to come up with a international agreement on capital liquidity standards that will both be tough, and the United States is leading the way in looking for a very tough set of rules, but one also that will be acceptable and agreed upon across the major countries.
Capital and liquidity standards, resolution protocols, how we handle derivatives, all those kinds of things. It's just important that we harmonize as much as possible. Otherwise, we could see a repetition of the Greek phenomena, not in the sovereign debt situation, but when it comes to financial regulation. So we've taken some major steps here, and if we're going to really get the full fruits of that, it's important we try and get as much of the rest of the world to go along. And I thank you for your efforts in that regard. And again, thank you for making Mr. Turullo available, and thank you for your service to our country.
Thank you.
Thank you, Senator, very much. Just on that point, we had regulatory arbitrage. You could end up with sovereign arbitrage, in a sense, if we don't try and harmonize those rules. That would be an important question. Senator Corker.
Thank you, Mr. Chairman. I was thinking the last time Federal Reserve Chairman was in and today, the difference between the way the Federal Reserve was being looked at 6 months ago and the outcome as it relates to this regulatory bill. He should have spiked the ball before he sat down, but I guess Federal Reserve Chairman don't show emotion in that way. But I know things have changed tremendously from that time, and I certainly appreciate you coming back, and would want to talk to you a little bit about the report that you gave. Obviously was disappointing to the markets. I think people are a little concerned about where we are. Do you discuss much in your meetings the probability of a double dip, and then can you give us some sense as to the future there?
Well, we certainly try to talk about all contingencies, and the committee has identified some downside risks to the recovery, including problems of credit availability, small business, some of the issues we talked about, the high level of unemployment, which in turn has affected consumer confidence and their willingness to spend. So there are certainly some risks. But I'd like to emphasize that our forecast, our expectation is still for a moderate recovery. The numbers I gave today of 3.5%, depending on the horizon, which will over time bring down the unemployment rate. So that's still our main scenario, that the economy will continue to grow and that the final demand, private final demand, will take over from inventory building and fiscal policy as the drivers of growth.
The ranking member asked you a question.